Okay, good afternoon. Let's resume our committee meeting now with next and last point in the agenda today, the exchange of views on the failure of Silicon Valley Bank and the implications for financial stability in Europe, with José Manuel CAMPA, Chair of the European Banking Authority, and Andrea ENRIA, Chair of the Supervisory Board of the ECB. So I want to welcome them both and thank them for their availability to discuss this topic with us and, all the implications of the SVB failure on financial stability in Europe. This follows last week's plenary debate. We had a debate on the same issue on Wednesday, March 15, where Mairead McGuinness, European Commissioner for Financial Services, Financial Stability and Capital Markets Union, said that the EU should stay alert after this collapse. As you know, U.S. authorities shut down Silicon Valley Bank on Friday, March 10, 2023, as VB had its headquarters in California and was the 16th largest bank in the U.S., catering for the financial needs of technology companies globally. The collapse of this bank is the largest failure of a U.S. bank since the financial crisis in 2008. Overall, 3 banks, SVB, Silvergate and Signature, failed due to liquidity problems as they ran out of cash to pay back deposits. SVB had invested in long-dated U.S. government bonds, which lost value when the Federal Reserve increased interest rates to combat inflation. When SVB started selling bonds to pay back deposits and announced on March 8 a US dollars 1.75 billion capital increase to cover the losses caused by the sale of its loss-making bond portfolio, it took just 48 hours between the time it disclosed that it had sold the assets and its collapse. The U.S. FDIC insures deposits of amounts up to $250,000 US dollars. However, the FDIC received exceptional authorization from the Treasury to announce that all depositors would have full access to their funds. In the aftermath of the collapse, European banks' shares fell heavily. Today, we would like to hear from you more on the impact of these events on the financial stability in the EU and the repercussions on the EU banking sector. Mr. ENRIA, you have now the floor for an introductory statement of 5 minutes, and then it will be followed by the introductory statement of Mr. CAMPA of another 5 minutes.
Thank you very much, Madam Chair. The failure of some mid-sized U.S. institutions revealed this month remind us that specific features of banks' business model can make its balance sheet particularly vulnerable to interest rate risk. In extreme cases, this can turn rising interest rates from a boost to profits into an existential threat. In this context, the case of Silicon Valley Bank is particularly illuminating. The institution concentrated both its lending activities and its deposit-taking activities among venture capital firms, fintechs and startups. More than 80% of its deposit base consisted of uninsured corporate deposits, which tend to be more mobile than other deposit types. Most of the bank's assets consisted of fixed income securities, which typically lose value when interest rates rise. As deposit outflows started mounting, Silicon Valley Bank liquidated fixed income securities at a loss, further exacerbating the run on its deposits and the strain on its liquidity. This happened in a U.S. regulatory context where mid-sized banks like Silicon Valley Bank are exempted from or treated preferentially under relevant prudential standards such as liquidity requirements, the LCR and the NSFR, and capital requirements. Such banks are subject to less frequent stress tests than larger ones, and they can be allowed not to reflect in their regulatory capital the unrealized losses on securities held in the balance sheet as available for sale. The episodes under consideration have been contained also by the prompt and forceful intervention of the U.S. authorities, which have committed to protect all uninsured deposits of the banks involved under what is known as the systemic risk exception, and set up a central bank liquidity facility accepted from banks' fixed income securities valued at par. There is no direct read-across of the U.S. events to euro area significant banks. First and foremost, this is because the banks we supervise do not exhibit the outlier features of extreme interest rate risk and predominant reliance on concentrated uninsured deposit base, which might be termed the SVB business model. Our banks generally operate with a more diversified customer base. Although uninsured deposits are an important source of funding in the euro area as well, they tend to be more relevant for business models which are well diversified on both the asset side and the liability side, including their deposit base. Importantly, all our banks are subject to the LCR and the NSFR requirements. Liquidity coverage ratio have only decreased marginally since the monetary policy normalization process began, and they averaged in excess of 160% towards the end of last year. More than half of the existing buffers of highly liquid assets are made up of cash and central bank reserves, which sensibly mitigates the risk of mark-to-market losses when liquidity needs arise. In fact, recent data indicate that those banks that have experienced some deposit outflows appear to have succeeded in maintaining their level of excess liquidity. They have done so mostly by issuing debt securities and reducing interbank lending, and only to a minimal extent by liquidating securities. The sector's overall liquidity resilience also results from the overhaul of the regulatory framework implemented in the aftermath of the global financial crisis and the choice made by the European Union and the European Parliament in particular to apply the international standards to all the banks operating in its jurisdiction. We are well aware that the ongoing fast-paced normalization of monetary policy conditions is increasing our banks' exposures to interest rate risk. We started assessing interest rate risk and credit spread risks as early as the second half of 2021, when the first signs of inflationary pressures emerged, and in 2022 we enclosed those risks in our supervisory priorities. Last year, we repeatedly measured the sector's response to a standard 200 basis points shock to interest rates, highlighting that the net effect on bank profitability and capital is expected to remain positive under the baseline macroeconomic scenarios. The boost interest margins give to net interest income has a positive impact on banks' earnings capacity. The effect this is expected to outweigh the costs associated with worsening asset quality as borrowers find it more difficult to pay back their loans. At the same time, we also reviewed the interest rate and credit spread risk management practices of the most exposed banks and instructed them to improve the way they monitor and manage the negative impact the rising rates typically have on their economic value of equity, that is, the net present value of their economic worth, of their balance sheet. When interest rates rise, the economic value of equity falls due, among other factors, to the reduction in value of fixed income securities, including sovereign debt securities. This happens irrespective of whether banks measure the value of such securities at amortized cost or at market prices for reporting purposes. If not appropriately managed and hedged, unrealized losses on securities that banks hold at amortized cost might become a concern, particularly because investors and sophisticated depositors tend to focus on market values when their level of confidence dwindles on the back of changes in fundamentals or even mere rumors. During this review of risk management practices, we asked some banks to be more conservative on their assumptions and when the assumptions they apply when stress testing credit spreads on financial securities. We also encourage them to improve the calibration, validation, and backtesting of their asset and liability management models to make sure that these models properly reflect the loan repayment and deposit withdrawals behaviors by customers in line with the new interest rate environment. Liquidity and funding risks have also been upgraded in our set of supervisory priorities. As the normalization of monetary policy started and the phasing out of the extraordinary central banking funding facilities came closer, our supervisors began in the second half of last year to devote significant attention to the sustainability of the bank's funding plans. Both euro area banks and supervisors are therefore focusing on the risks and risk management practices that are most relevant given the fast pace of change in the interest rate environment. The market turmoil triggered by the failure of the US banks have been further aggravated by the significant drop in share prices and spike in credit default swap spreads experienced by Credit Suisse last week. While euro area banks saw their share prices tumble, their funding and liquidity positions were not materially affected, reflecting the continued resilience of the sector. Credit Suisse, a globally systemically important bank engaging in a complex refocusing of its business model, was already subject to significant liquidity outflows in the last quarter of 2022, and in order to restore trust, the Swiss authorities provided Credit Suisse with a large volume of liquidity support, and the details of the bank's acquisition by UBS were finalized over the weekend. The ECB has issued a statement welcoming this outcome, and we are clarifying in a joint statement with the Single Resolution Board and the EBA that the hierarchy of claims is clearly defined in our resolution framework, and CET1 capital would always be first to absorb losses and would be fully written down before additional Tier 1 instruments could be written down. This approach has been consistently applied in past cases, and we will continue to guide the actions of the SRB and the ECB supervision in all crisis interventions. Thank you.
Thank you very much. Now I give the floor to José Manuel CAMPA.
Thank you, Chair, and honourable members of this committee of the European Parliament. Thank you for this timely invitation to exchange our views. In the past days, we have been confronted with events that have raised concerns on the health of banks and increased volatility in financial markets. First, there was this crisis. There were bank failures in the US. These bank failures were idiosyncratic in their business models and affected US banks with only limited exposure to the European banking sector. A very concentrated client base with large uninsured deposits, as has been described, and lack of proper risk management have paved the way for the liquidity challenges that morphed into solvency concerns, leading ultimately to swift resolution by the U.S. authorities. Uncertainty remains on the situation of some regional banks in the U.S., with proposals from the private and public sector to provide liquidity support in an attempt to stabilize deposit flows for certain regional banks. Then there was last week the situation with Credit Suisse, where here a prolonged restructuring of the bank that have had repeated risk management failures made markets and investors lose confidence. 2 years ago, Credit Suisse had already lost $5.5 billion during the Arcello's collapse, and other issues, including green seal exposures in their funds and a weakened franchise, was losing customers, raising concerns on its viability over the medium term, which materialized over the weekend. Those failures hit at times of heightened uncertainty and geopolitical risk in the macro context and major societal transformation in response to the energy crisis and to climate change needs. As monetary policy is changing course, there is no time for complacency. Over the past decades, we have faced low interest rates. Now, with a gradual increase in rates, banks were beneficiaries in the short run of this increase in rates. Their profitability increased last year as net interest income and interest margins gains materialized throughout the year. But on the other hand, as we warned, an increase in interest rates have impacted also valuation of financial assets, and expectations of potential deterioration of credit quality going forward will continue. Bank deposits have also become more sensitive to interest rate differences and become susceptible to be moved at short notice, particularly with the increased digitalization and instant communication that may easily accelerate the quest for deposit yields across the world. These issues raise questions on the viability of some business models over the last 2 weeks, and adding a pinch of uncertainty on financial stability that may then reinforce a downward spiral on overall trust. Therefore, all banks, I think regardless of size and complexity, need to manage this new environment in which rising interest rates and increased volatility is key to their macro outlook. At this point in time, we are confident that more than a decade of work has put the EU banking system in a better situation to address these challenges. Banks have better capital and liquidity positions. The regulatory framework and the single rule book has added a layer of resilience to the system, and enhanced supervision and governance provides also better risk management. The EU banking sector today shows capital ratios and leverage ratios that stand at comfort levels, with a core equity tier 1 ratio fully loaded of above 50% and a leverage ratio also fully loaded of 5.5%. EU banks vastly exceed the minimum liquidity requirements as stipulated by the LCR and the NSFR ratios, and at the EBA we're closely coordinating and monitoring the situation and exchange views with our BOS members whenever needed to assess the situation. The single rule book also provides a robust regulatory framework. The comprehensive application of the Basel framework to all banks operating in the EU further ensures the resilience of the European regulatory framework. In particular, as was already mentioned by Andrea, the Basel standards on liquidity risk, the LCR and SFR, have been fully implemented both at an individual and consolidated level in the EU banks. These contracts with the US, where international regulatory standards only apply to the most significant important banks. As we have learned with SVB, with Silicon Valley Bank, even the failure of a less significant bank could trigger a crisis of confidence with knock-on effects to other banks. And this shows that completing the regulatory package with a timely and loyal finalization of the Basel package is important from my perspective. Enhanced supervision and governance also by banks has put us in a better position to assess risk in a more forward-looking manner. For instance, the sensitivity of banks to changes in the interest rates has been in the focus of EU regulators and supervisors for over a year. We at the EBA will publish a comprehensive regulatory package on the management of interest rate risk in the banking book last fall and increase our scrutiny of the way banks are managing this risk by launching a new quantitative impact study on this issue earlier this year. As mentioned also by ENRIA, the ECB banking supervision performed a review last year of the interest rate and credit spread risk management practices on the significant institutions in the euro area. We're currently in the middle of performing the EBA stress test exercise that hopefully will provide further evidence on the resilience of the largest banks in the Union. We have increased coverage for this exercise in the number of banks included, 70 banks compared to the previous exercise which only included 50 banks in 2021, and we use particularly severe assumptions in the adverse scenario. The adverse scenario puts banks to the test of high and persistent inflation and interest rates and a severe GDP contraction. It also enhances the sectoral decomposition of the scenario to more granularly stress the credit portfolios of banks. This is a stress test that focuses on solvency concerns and should provide additional clarity on the resilience of banks in an adverse scenario. Recent crises show that despite having enhanced banks' capital and liquidity positions, having a strengthened regulation and enhanced supervision, bank failures and lack of confidence may still take place in the system. We therefore need to remain vigilant and not be complacent. I would see three takeaways for policymakers and regulators from the development of the last weeks. First, upholding the confidence in a strong regulatory framework requires, as I mentioned before, to complete the pending regulatory packages. We have to implement Basel III standards fully, timely and faithfully. The completion for me also of the other pending legislative files, such as the AML package, will foster market confidence by providing better supervision and enhancing also the scope of supervision to new areas and new players, such as in areas such as crime prevention in the financial sector, and I think that will also enhance resilience. Second, as is well known, the European banking sector remains fragmented along national lines, and there is no rationale for Europe to keep the banking union resting in two pillars only. Proper risk and capital allocation need the foundation of a common deposit insurance scheme and a crisis management framework that also needs to be a strength to reduce fragmentation and divergences across the union. Finally, and likewise, the capital market union remains incomplete. Both of these large progress merit proper translation from political ambition into reality to prepare our economy for potential more volatile times to come, but more important also to address the finding needs of our future economic growth. We will continue to monitor the events and we stand ready to provide our expertise going forward. Thank you very much for the invitation and I look forward to your comments.